get an A in my class. All right. What do you think, David? 5 minutes or?
Pressure's on.
What's the pleasure of the
Pressure's
board?
on.
I don't want to, again, obviously, we don't want to sort of rush in terms of content. Okay. I wonder, what's the pleasure of the board? If there are questions, would you rather, I don't want the tone to be, we're just trying to rush through to get to lunch or end early. I want us, this is important information, so what's the pleasure? We can, yeah, let's do it. Let's do it.
If it takes us till
So
one, it takes us
David,
till
we'll
one.
just have you guys present and then we'll break for lunch after that. So just do what you need to do, David.
Okay, thank you.
No time rush.
This is the second reading for the Global Equity Policy Revision. There were a few changes that we made. The first one, these are additional changes. We kept the original track changes. One of them was adding the concurrence memo from PCA that Mr. Moore recommended. And then the second thing was explicitly defining the internal management parameters. And if you would turn to INV 462, it's under the Global Equity Internal External Management section, subsection 2. We added internal staff shall only implement index-based investment strategies with a maximum forecast tracking error of 50 basis points. And so what we're doing with any strategies we're bringing in-house, they're going to be very passive in nature, and we're going to manage to a particular benchmark. One other change that we added was the trading limit authority for the Deputy Chief Investment Officer, which is a new position for CalSTRS. So with that, I'd open up to any questions.
Okay. Questions? Paul, there you go. Paul.
Thank you. So can you explain that last comment a little bit more? What the tracking error, forecast tracking error, and what is this seems to be talking about a policy that allows for internal management of a portfolio with a certain expected risk profile, but if it's something larger than that, then that wouldn't be internally managed. Is that, am I accurate in that?
Maybe we can just go through one example
Okay.
of what was approved in the 2011 internal-external. One of them was equal-weighted S&P strategy. With that strategy, we would manage it internally to that index within 50 basis points. But if you compare that tracking error relative to the Russell 3, which is kind of like our passive benchmark, the tracking error would be pretty enormous. It'd be over 150 basis points. And because of that, we wouldn't put that in the passive bucket. That's why we would put it into the active. And that's just one example of a strategy that was already approved by the board.
Okay.
We'd be managing it to a particular index passively.
Okay, so I guess you got to help me because I wasn't here
Yeah.
in 2011. So,
I understand.
So the concept of tracking error is that we're not trying to replicate the Russell 3000 internally. We're trying to accomplish something different from that
Within the active portfolio, correct.
within the active portfolio that is internally managed.
Correct. Well, internally, let me talk about the active portfolio and the passive. Internally, we run a $37 billion Russell 3000 portfolio, and its forecast tracking error is about 2 basis points. So we manage really tight with that particular strategy. Yeah.
So that means that what is being earned has a very, very low deviation from the Russell 3000 itself.
That is correct.
But every time we're actively managing a portfolio, we're not trying to replicate the Russell 3000. That's the whole point of active management, right?
So what would be active in that situation is the fundamental index, the strategy. The implementation would be passive. And, I don't know if you want to opine. There are other strategies that we could do internally. Low volatility is another one. It's another strategy where it would have a higher tracking error to the Russell 3000. We would manage it passively to a low vol index, and it would be, it's.
Here's what
Yeah.
what I'm having a hard time understanding is, so is it that we're saying that that we will manage internally, actively manage portfolios where where we're defining that actively managed strategy such that that actively managed strategy shouldn't have a deviation represented by tracking error from the Russell 3000 to 50 basis points or more, or that we are defining some strategy and then we are saying, and the results should not deviate from the expected returns of that strategy by 50 basis points. Okay,
The latter is
so-
exactly right on.
So why if there's a strategy that is represented by some kind of index, why would we have that much deviation at all?
You're talking about if we're why would it even go up to 50 basis
Yeah.
points? Why wouldn't it just be 5 basis points or 2 basis points?
Right. In other words, if we're saying, that the strategy is to replicate this
Right.
other index, not
Right.
the Russell
And
3000
just to
index.
give you a flavor of what active management is in our portfolio, if you look at our active managers, it's pretty much 300 basis points and above. We have some managers that are probably in the 500, 600 basis points of tracking error.
Relative to what, though?
Relative to whatever index they're managing it to.
David, can I jump in?
Yes.
Paul, to answer your questions, why 50 and not 5? The enhanced indexes, so let's say you own 490 of the 500 stocks in the S&P 500, that could have an expected tracking error of as much as 50 basis points. Below 100 basis points is considered what they call an enhanced index. The index can be a variety of things, but we think 50 is at the high end. We think we're going to run most of these within 20 basis points, but we want to recognize that some of these strategies, like one of the ones we've talked about with the board, is a global sustainability index. That may have a lot of names in it. We don't want to own all those names. We don't want to replicate the index. We just want to closely track it. So we're just trying to give ourselves some latitude, not to make a lot of active judgments, but to be able to run some enhanced indexes. To define it technically for the auditors and everybody, we're saying an enhanced index is about 50 basis points. If you bought those as a mutual fund in the prospectus, it would probably say 150
So
to
we're
200.
we're trying to sort of replicate the strategy, but not the specific index. And we're leaving some discretion to not own all 500 securities, but to own 490 of them. And given that expectation, there's going to be some tracking error, but we're saying it's got to be within 50 basis points is what our expected tracking error would be.
Yes.
The maximum.
You're going to help us judge, is that a good strategy or not? Say an equally weighted index or a fundamentally weighted index or a sustainability index. I'm going to measure David and Candace and the staff on, we bought this sustainability index from MSCI, how tightly did they nail it? Did they get it and earn a little bit of extra return, or did they underperform it? So they'll be judged at that level, and then we get to judge at the higher level, do we want to do active or not?
And can
Neil,
I just
you're-
okay.
actually with a
Yeah, I think
question
Neil wants to
specific
jump in too. So
to, well, let me
Go
pose
ahead.
my question to Neil too, because
You got it.
it's in the
Absolutely.
PCA
Yeah,
letter.
Absolutely.
My response first before the question.
Sure.
Wait, I could duke it out right here.
Well,
I'm just
These
saying.
strategies that we're talking about that we can potentially replicate, you have the market cap weighted Russell 3000 benchmark, correct? The widely followed S&P 500, which is roughly market weighted, but not quite. Those are very easy to replicate because they're based on cap weighting. These other strategies are rules based. So they say, they might tilt based on a couple of rules that we have for this index. We'll apply these rules and we'll tilt towards a certain systematic factor. When you have a rules-based index, they're marginally more challenging to track than a cap-weighted benchmark. So the 50 basis point allowance is just to widen that understand that there's a little bit more challenge in tracking a rules-based benchmark than the straight-up widely followed cap-weighted benchmark. So it's more of just a practical acknowledgement that these things are moderately more difficult to track. But even at 50 basis points, and that's a maximum, most of these things are going to be managed tighter to that. I think David and I, they're going to be managed probably around 20 to 25. That's getting to, when you get to that level, it's very much an index fund. But it's just tilted towards this rules-based benchmark.
All yours,
And
Bob.
then to follow up with something in your letter, regardless of the portfolio being measured, the proposed tracking error constraints forces the aggregate of all portfolios to be driven nearly 100% by systematic risks rather than idiosyncratic risks associated, lots of big words here, with security selection. So what you're saying is that while we may have more tracking error in one portfolio, when we look at sort of the aggregate of all the portfolios, we're going to actually see even less risk, but that's what we'll normally see with diversification,
That's
right? Okay.
Chris, do you want to chime in?
I'm just for the board's education. The fixed income portfolio is also run in-house, I would say as an enhanced index to an index. Their expected tracking error is about 35 basis points. So that gives you a comparison to other portfolios we do. Fixed income world, how many things are in the index? Securities, 9,000? Yeah, so there's probably 9,000 things in their index. We don't want to own all of them. Couldn't. So that's a good example, though, of they are able to do this pretty scientifically. They are going on about 8 decimal places. And I think, as Neil has said, we have very good tools to be able to tell us exactly how tightly we're doing it.
Thank you.
Okay. Okay, this is an action item, so any other questions? I'll entertain a motion to approve.
So moved.
Second.
All those in favor say aye.
Aye.
Opposed? Abstentions? It's approved. Okay. Let's go ahead and take a break from lunch. It's 12:40-ish, so let's come back at 10 after 1. Is that okay, half hour? 10 after 1, we'll reconvene. We are going to start with item 16. Chris, the selection of the general investment consultant and division of duties.
I'm passing out for you the information on the comparison of the different consultants. The first summary sheet, and Michelle's passing out the fee detail breakout from procurement. So Microsoft.
That's me and Sharon.
Yeah, that's our extra space. Oh, is that, oh, you got it? Has everyone got both of them? Michelle? Just 2 documents, right? One stapled and one regular. Okay. I think we're good.
There we go, on the microphone, so it's on the record.
Yes, so Chris,
You selected 2 potentially successful candidates after your interviews in February, PCA and Makita. You then, at the last meeting, discussed slicing scope A and B in a different way, which we have done and given to them scope A, or, well, I would say, I think the best way we could describe it is a lead consultant that would be very similar to our traditional retainer full-service consultant. All the duties, responsibilities, all the policies, all the things that the consultant's done for the past 3 years would remain in that. And then also a co-consultant that would give you a second opinion on any policies if they differed. You asked that they would provide input to staff on the asset allocation and input to you on the asset allocation semi-annually with their point of view. And then you asked that they be involved and provide research for the 2 big projects that the investment committee has annually. We went back to both those firms. Procurement asked them to look at their fees and reshuffle them. As you can see in the detailed breakout from procurement, they've given you the year 1 through 3 and then 5-year total cumulative. On my summary, I tried to kind of break it out to, what's the traditional annual retainer look like from these firms. They were required to stay within their original quote, so they just sliced those up differently. Both firms said if given the chance, they would have adjusted it a little higher, given the work volume. In the end, the structure of having a lead consultant and a co-consultant is slightly more expensive than just having one lead consultant. But I would say that you're adding a little bit of extra cost to get a second opinion, which you were pretty clear you wanted to have. What I've said to some people that ask questions about it is at $180 billion, we are such a massive fund, and especially given, as you heard yesterday, the actuarial situation of the fund, investments are more critical than ever. And as a mature plan, they brought out that we were very sensitive to investment return. Now more than ever, you should have another set of opinions on everything we do, and so it's a small price to gain that extra set of opinions. So at this point, you would select which firm you want to be lead, which firm you want to be the co-consultant. You would direct staff to negotiate the final contracts and either direct us to negotiate fees or accept their quotes. With that, I'm open to any questions.
I don't see any questions yet, so I'm going to jump in and ask a question. And that is, I don't necessarily understand this world. So on the one pager that you give us, Chris, with the amounts for the fee comparison, I guess I don't understand when it says if allowed to rebid, that they'd quote a higher. I don't get that. What does that mean?
In procurement, they under our RFP rules, they have to post their original price. I was just, for the sake of the consultants, both had shared with me that, once they had a chance to relook at it, hear from what you said. If they were given that option, you don't have to give them that option. They're required, like.
It's higher. I don't want to give them the option.
Yes, I understand.
It's higher.
No, I just was trying to give you a rough spectrum. And to
Okay.
give you a spectrum of, these fees are very similar to what, there are only a handful of funds, obviously our size, very similar to what they pay. The larger fund than us in town pays more. Smaller funds pay a little bit more. These are not out of line. I would also point out your consultant costs, according to the CEM universe, which does pick up some of the Canadians and the Dutch plans. Your consultant costs tend to be about 80% of what plans our size typically pay. So even though the fees are very large, they do show up in CEM as being very reasonable. Not very reasonable. Pardon me?
Generically or for
The consultants that CEM picks up, I believe, are your top three, but so this being probably the largest. And they're here in the room, so they're welcome to come forward if you have questions of them, or up to you.
Okay. I'll leave it to the will of the board. Tom?
Hi. I endorse this approach. I think one of the most telling things on the chart you handed out is if you look under asset allocation model, you see two very different types of methodologies. And I think that since asset allocation is our biggest issue, having the benefit of two different, well-respected academic approaches is very important. So I think this is a great approach, and I'd be on the side of letting them up their bids if on the co-consultant side, if that's what makes it a comfortable working relationship.
Okay. Thanks, Tom. Terry?
Chris, could you please explain the difference between this sheet and this front sheet? I think I see some differences, and I may know the answer, but I'd like to hear it from you.
This is the official sheet from procurement. Procurement staff asked for, and number one, the fees are bid flat, the same fee year 1 through 3. and then they're allowed an escalator in year 4 and an escalator in year 5, and so they are providing that for you here. Yep. And then procurement also, as we, starting back in December, as we started to look at different splits of the scope, procurement went back to the firms and asked them, and that's what these subsequent sheets are, they asked them to bid these in a breakout, sort of à la carte menu, and that's what they are. It's hard because you have to know within each whether it is a service that was included or whether if you bought that service separately, it was a standalone, but at least the detail was there if you wanted to adjust what was in the lead and co-consultant. This breakout, part of what, if you look at the old category A and B, and I don't want to get too caught up on them, one of the services under category B, asset allocation consultant, you asked both the co and the lead to provide asset allocation monitoring and interaction monthly and a semi-annual report to you monthly on strategy. In the procurement page, they bid that down in category A, or B, I'm sorry, but if you accepted that some of those costs rise up. So this is, when I asked them that question, this is the number I got back. They do reconcile, if that helps. They're just different breakouts of the à la carte menu.
Thank you. Couple of questions. So the separation of the duties into the lead consultant and the co-consultant is, are these separation of duties, are they agreed upon by both firms that these make sense?
I think that's a great question to ask them. I believe the answer is yes, but I would hate to speak for them.
Okay, because I don't know the conversations that happened since our last meeting, so I would just, want to make sure that if we're hiring people according to these
Yes.
responsibilities, that they think that they can do what we expect of them.
They're not
How can
moving
I-
until you
Separating
tell
out
them to
responsibility.
move. They do
Can I
pay
ask
attention
them
to
that?
you.
Yeah,
So
sure.
could we invite the Makita folks and PCA, have you come up and let us chat with you directly instead of doing it indirectly through the CIO of CalSTRS? So we'll just, you guys have been watching our board for a while, so we're kind of, we just want to have a straightforward conversation. So go ahead, Paul.
I think they heard my question.
There you go.
Yes, we're comfortable with the new format.
And you'd be comfortable playing either role?
I'm not gonna opine on that one.
I think that was made clear. on the-
Pressure button.
Makita's comfortable with the framework that's been laid out, and we would also, as I'm sure PCA would as well, acknowledge that as this is a new structure for you, that some of these duties and overlaps are somewhat fluid over time, and we're happy to kind of adapt to whatever works best for the board.
So the other question I guess I have is just, again, trying to read this, and this isn't so much a question for Neil and Steve, but I guess back to you, Chris. So the way to read this is if these are if we're over the 5 years, that if PCA was the lead and Makita was the co-consultant, the cost would be $6,543,000 for PCA plus $2,340,000 for Makita. So about $8.9 million. And then if we flip the roles, then it would be $3,537,000 and $4,122,000, or about $7.6 million. Okay, thank you.
You good, Paul?
Those are my questions.
Okay, Dana?
So I want to make sure I understand what I'm looking at here too. So Chris, under lead consultant, it talks about the contractor provides continuous review of the asset allocation amongst other things. And then under the co-consultant, they're actually responsible for doing the semi-annual evaluation on the asset allocation. So that's different than what the lead would do, correct?
Yes, you had, from the notes I had from our February discussion, you were thinking the co-consultant would present at least a one-page or a two-page sort of their thoughts on the asset allocation. So the lead consultant would present a semi-annual report very similar to what you saw, and the co-consultant would come forward with a one, two-pager at max, just on the asset allocation of kind of, here's our thoughts.
I'm sorry, could you repeat that?
Yes. So the lead consultant would still provide the semi-annual report and an analysis of asset allocation, very similar to what you heard today. And from my notes, the co-consultant would come up and have a one or two page of their analysis of the asset allocation, where we got into timing and the attribution of the asset allocation against its benchmark.
Okay, I guess I just don't see that in the lead consultant then. I see the actual report, the evaluation of the asset allocation, under the co-consultant, not the lead.
You don't see under co-consultant the one or two page report on the asset allocation?
No, I see the report on the asset allocation. And that's just opposite of what I think I just heard you say.
I'm not following what you're saying.
So Chris, you said that the lead consultant will do the annual report on the asset allocation. I don't see that under lead consultant. I actually see that under number 2 on the co-consultant.
Yeah, no, that's one of the things we got into, was breaking this out in incredible detail.
And I
It's
mean,
part
and-
of the scope, yeah, Robin's presenting it to me, it's,
Yeah, number
item
6 on the
6.
lead, it
Yeah,
talks about a
6 and 7.
continuous review,
yes,
but it doesn't say the report. So I just want to make sure that that continuous review includes the report.
yes.
And
Seven is the one which is the bulk of the report.
But it just says evaluation of the performance of investment managers. It doesn't say the asset allocation.
Oh,
That's what
okay.
confused me. I just want to make sure that I understand what they're actually,
Yeah.
what we're actually going to be asking our lead consultant to do. All right, so they're both going to opine
Thanks, Robin.
on the asset allocation and evaluate that.
Yes.
One, the lead in more depth than the co. All righty.
Yes.
And then category B is both lead and the co-consultant. The language within the box that was in what we were provided is all singular, so contractor, but it is contractors, correct?
Correct.
Okay.
And again, as, this is up to you. As you were telling us, that was the way we noted it. You wanted the both firms to perform both roles.
Thank you. That
Any other
concludes my.
questions? So, Paul?
So the responsibilities in category B would be the same. I mean, whoever was lead or co-consultant, they would have the same and equal responsibilities on category B. So would we anticipate that we will then pay them both the same because they bid different amounts?
No, you would pay them the different amounts.
Okay. And that's because that's the way the contract.
That's the way they bid.
Okay, thank you.
And as you'll see, given the way they looked at it in the new way, they tended, in the one-pager, they tended to think of the once every 3-year project as kind of being included in their annual retainer. So both firms have said, and you guys can obviously correct me, that based on the co and the lead consultant structure, they wouldn't have an additional charge for the once every 3-year asset allocation. It's incorporated in their annual retainer.
That clarifies it, thank you.
Any other questions? So the action item on the floor is to approve the final selection for the, let me just make sure I'm looking at this, the general investment consultant lead and the co-consultant, so,
And the duties attached.
and the duties attached.
Jan,
Yeah,
I
Brian.
just want to make a clarification on the staff recommendation on investment 476. And specify that there's an option of two-year extensions, not the way it's stated. It sounds like it's automatic.
So say it the way it
The
should
contract
say.
term will be 3 years with an option of two.
With an
two
option.
one-year
So we're
extensions.
missing the option part?
Yeah.
Got it. Everybody have that? Dana?
All right, I will move staff's recommendation to approve the attached scope of duties and the contract terms to be 3 years with 2 one-year extensions, the option of two one-year extensions, with PCA being the lead general investment lead, and Makita being the co-consultant.
Any discussion? All those in favor say aye.
Aye.
All those opposed? Abstentions? Motion passes. Great.
Thank you very much.
Thank you.
Thank you.
And thank you, Makita. We're really looking forward to working with you, and thanks for being here. All right. Thank you. Well, Neil, we're old friends, so. Great. Excellent. All right, so item 17 is an information item. Chris?
Real quick, if you would turn
plan?
to INV 482, that text box that you see there, the best way I can describe it is that's your voting ballot for the June meeting. We would take this literally out and put it in a single page and give you 7 points, and you would award those 7 points as you see fit. You can spread them across them or vote all 7 points for one thing. That system has seemed to work for past committees, but it's up to you to change. You wanted at this meeting your chance to debate and advocate for what should be on this ballot, on this menu list. You can cross anything off. This is a combination of what has been on past lists and what you have mentioned, or at least we've heard you mention in the last couple of months. The other thing I would say is, while you might want to select all of these to do next year, given the volume of work the board has and certainly the technology projects that are before you and the unfunded liability, we'd still recommend that we stick to no more than 2, one for the fall and one for the spring. Sometimes we tried to add a third, but it really gets back to how much time the committee has to be able to spend on it.
Chris, can you come, where do we see this happening in the what months or what meetings do we see us tackling
Let me
these?
see if I can get, there we go, I flipped right to it.
'Cause
So
I
if I
know you
could
did
get
that.
you all the way back to INV 7, that would be the work plan, like this.
Okay, it's in the work plan.
The projects are the boxes up at the top. And this list comes back to you in June. You vote on it, and then Sharon, as the chair of the investment committee, would present it to the retirement board, back to you, at the July meeting, where you would adopt the investment committee's work plan for the future year. The fall project, usually we get most of it done in September, November. Obviously, December is usually just your consultants, so it sometimes carries over to the February meeting. We would try and start the other project in February and then finish it up at least by June, and we kind of cheat over the year and creep a little bit into July, even though that's the next fiscal year sometimes with those projects. So that's why I tend to say there's kind of a fall and then a spring project theme to them. Depending on the subject, we've sometimes been able to get it done in 2 meetings. More complex things, I would tell you, actually took an entire year. And to Tom's probably nightmare, I think Stephen got the record for over 500 pages on commodities. So that was over several meetings.
It's a new day, Chris.
Over
It's a
several
new
meetings,
day.
but it was 500 pages.
Don't
We
scare
gave him an
him off
award.
right
Yeah,
away.
really.
Yes.
Yeah, that's what my students do. They
The
try to
investment
Not
committee
make it
rule,
smaller.
8 points.
nothing
like
more than
a-
8, yes. So that is a limit.
So, Chris, how best should we give you this input? Should we give it to you in written form? Do you want us to
Oh, he'll
verbally?
send it out.
You going to send it out to us? Or
I would really encourage you, if you have strong feelings, to bring it up now, because I think one of the drawbacks the committee found in the past was it didn't give you a chance to advocate for a particular topic that some board members might have a lot of passion for.
Right.
Some board members, I can't think of who it would be, had a real interest in timber. I'm being
This board doesn't have passion about anything.
somewhere, yeah.
They're not working in weed, they gotta work somewhere else.
I know. So anyway, yes,
Okay.
some board members have had a passion for particular topics. This would give you the chance to, I guess, advocate for that topic.
We've got a couple folks who want to chime in, so Frank?
Chris, what's the $1 trillion clean investment pledge?
The $1 trillion clean pledge is a pledge we've already signed as a fund. Jack signed it with Ceres. Ceres is trying to get institutional investors to commit to investing some portion of their assets into clean technology for a clean environment. Their goal is to get $1 trillion a year for the next 35 years. And so it would be a discussion of, and I was thinking you might even want to add to this list as an other, if you want to review divesting fossil fuels as another subject. The Clean Trillion Pledge links to that a bit, but it is a different, a clear pledge that's out there. And institutional investors are just starting to kind of figure out how to respond to that.
Okay. Paul?
Yeah, I'd like to actually raise an idea, and it really comes off of what Alan said in the several times today, as well as I think in some other communication that we've seen, which is we've had a great run, and the expectation is we shouldn't expect that great run to continue. So what do we do when that great run comes to an end? And I think given that specifically, what does that mean for a system like ours where while we have, keeping our fingers crossed that we're going to see some improvement in our funding, right now we don't have that. We know that even if we have action taken to lead us to full funding over 30 years, that our funded status stays low for a long time, in fact drops for a while. And so if that's happening at the same time that the market turns against us, what does that mean for this fund? We don't have, we as a board don't have the ability to respond on the contribution side. We can only do it on the investment side. And so I think it puts us in a very different position relative to other pension boards, both given where we start and what our powers are. And we have now one of our two consultants telling us that we expect things to,
Yeah.
So what does that mean? What does that mean? And we get our actuaries who come in and they talk about what things will look like, but they make an assumption that we're going to get 7.5% each and every year when we know that we're not. We're going to get better some years and not others. So I guess shorthand is what do we need to be thinking about? How does it affect our thinking about our investment strategy, given the funding situation we have, the powers that this board has, and the fact that we might be looking at a time when the market is moving against us?
What do we call that, Chris? Alan?
Yeah, Alan.
Yeah, Alan, you want to give us a pithy title for that topic? Is it crystal ball, perhaps, or? But I agree with Paul. That's the question for me. Is what?
Luckily, for me at least, I've already gone through this with other clients, and really what we call that is shortfall. And shortfall, and then shortfall management. How do you manage around it? And that addresses all of the issues that Paul raises in just a few words.
Excellent. I mean, it might. We can talk more, but it might be great to have a speaker come in, or we can talk about ideas of how to think about that. But I'm guessing there's a lot of people around the world asking the same question. So I like that topic. Any other input from board members? Anything else? So
The one
yeah,
thing
Chris.
I make a comment. This is a long list. Is there anything you want to cross off, or obviously things will? If they don't get votes, then that's another way to do it. But
Well, just my comment looking at the list is just, since we've retooled the agenda to do deeper dives on the asset class, then kind of almost half the list to me seems like we're addressing it in a different format. So, and I'm excited after our closed session today, I think that's a helpful thing. So the other pieces, I guess for me, I will say that the issue you bring up, that's the thing that keeps me up at night, you know, as a trustee of this fund. So to me, that's probably, if that's the only thing we talk about next year. But I guess what I would say to other board members, if you have other input between now and they can let you know. Email Chris.
Definitely. If you have other things you want on the ballot, you could email me. We'll be putting this agenda together. I haven't asked Susan, but the June mailing date's probably early May, and we'll send that out. At the June meeting, my hope is that technology-wise, we're actually quick enough to collect those from you, score them, and then get them right back to you, so that you're aware of what, at least, this is in essence the investment committee recommending to the chair what they want to study, and then the chair's presenting it to the board in July. That's when this list is actually formally adopted, but it's obviously yourself talking to yourself.
Is it amenable to the board? I mean, if you want to have a ballot with items that we could just kind of cross off the comprehensive review of
We will, no, to be, because you need, it'll be an action item, and so we'll have you vote.
Okay,
Give us your ballots, then we'll total them up and report them all out in public, so we're all doing it at the meeting.
excellent. Sounds good.
In responding, please send it directly to Chris and don't copy all.
Of course, we're learning. Thank you, Brian. Thanks for the reminder. Tom?
You know, as I'm thinking about this, which is admittedly dangerous, it would seem to me that it'd be very helpful to me as a director to know what, how Chris would order these things if he had his choice. He's managing the portfolio.
Yeah.
He's thinking about our issues. I'd sort of like to see how he'd order those. And similarly, I'd like to see how our two consultants would
Interesting.
before we vote. I mean, I can make a random set of choices, but it'd be skewed.
Are you talking
to
about from this list that Chris is presenting us right now, Tom?
Huh?
From this list that Tom,
Yeah, I mean-
that Chris is
Yeah.
presenting?
Can you guys come forward too while I'm talking? PCA and
You want them to
Nikita?
we're just doing this
There
on the
you go.
spot, huh?
Nikita didn't run. I mean,
Wow.
they're not under contract, but come on, they can do
I
it.
guess your job starts now. It's
They're
never.
just saying what they like.
It's never
You know, I
dull.
think when I look at this list, Tom,
Yeah, no, next, before the meeting is fine. I mean, you
Oh,
don't have
okay.
to do it.
I
off
was
the
just
top
gonna
of
say,
your
I
head.
didn't expect to have them to do this right off the spot, but if they want to.
all right. So you're getting off the hook, you're being allowed to they're giving you time to think about it.
That assumes a fact, not an evidence, that I think.
It's like a pop quiz.
We're paying you a lot of money.
It's
to do
after the
that,
vote, unless you want to reconsider.
Alan, we're paying you a lot of money to either do it or act like you do.
Ba-dum-bum. Okay.
We'll respond in a timely manner.
How's that? So we'll give you some time. No pop quizzes today. So, because you said that then we'll get this back in June, vote. So just be prepared, Makita, PCA. Chris, give us your rating. And add Paul's item in there too, so that they can weigh in.
The shortfall.
Although that's an easy answer because they know we want to do it, so. Okay, great. All right, so we are on to item 18. Glenn and Paul, fixed income policy revisions. Hi, Paul, Glenn.
Okay, Paul Shantig, Glenn Hosokawa, Acting Co-Directors, Fixed Income, presenting three policies, two of us to present three policies, and PCA as well. In terms of, I don't know how you'd like to handle this, would you like to take just one at a time? And I can just briefly review, and for each policy then, sort of the major changes.
I'm sorry, so Paul, you're doing 18 and 19, oh, and 20.
And
So
20.
fixed income, currency, and securities. Pleasure, should we just have them go through each three and then, because they're informational items, so, yeah, so go ahead.
The first policy, the fixed income policy, major changes that you'll see in here covering X firearms. We've also added the DCIO position in the chain of command. And we also deleted the fixed income annual report as you received that as part of the semi-annual reports. It was considered sort of redundant along the way. That's kind of the major changes in the fixed income policy. There's been a lot of wordsmithing and changes like that in the policy that have occurred. So if you have any questions, we could.
Any questions? Good, nope, seeing that, oh, okay, Paul.
Okay. When I move over to.
Sorry, Paul. Sorry, Paul. Paul needs to
A
ask a
couple of
question.
the other ones, which is, so on INV 492, there's reference under section 7 to applying a board-approved criteria matrix to evaluate it, basically whether to do things internally or externally. So I guess my question is, where is that matrix and why is it not part of the policy itself?
Good point. It was part of the 2011 internal-external study that we did. I suppose we could have used it as an attachment.
You're right.
But we were all familiar with that as we did a presentation through that time period. And it has become kind of our, if you will, checklist that we go through if we consider new asset classes along the way. So we always refer back to it, but you're right, it's
So
not.
it's in our policies, but someplace else.
Actually, it was probably more in an agenda item, so it's a good point. It was, it's not in the policies. It's, I think, 2 pages, one-sided, or 1 page double-sided. We can include it in these policies.
Yeah, at least like.
Oh, it's in the guidelines? So it's actually in the written guidelines. So a layer below the board. You approved it, but we can bring it up so that it's there.
Okay. That was a
Okay.
question.
Great.
Thank you.
Thanks, Paul. Are we ready to move on?
Moving along to number
So-
19.
So currency, number 19?
Currency changes in the policy was the addition of ESG language. We also added language, which is something that was approved by the board earlier on in terms of allowing the internal staff to do foreign exchange as part of the normal duties of what they would do to handle that in-house. We also, again, added the DCIO, Deputy CIO position in, and we also took out the currency annual report is, again, it's part of the semi-annual reporting that you normally get. It's kind of the major things that have occurred in that policy. Any questions?
Seeing none, we can move on.
And the final one, again, I'm going to probably sound a little bit repetitious, but
That's
again,
okay.
these are all things that have been brewing that we've now been able to put into policy. Again, the ESG language has been included. The director of fixed income is responsible for security lending. Actually, has been through the entire program, but it wasn't in the policy, so we just added that in. And we also made mention that monthly reports are included to the CIO and DCIO, have been going on to the CIO for quite a while. We just put that into policy in here. So again, kind of a robust reporting in the securities lending policy that we have. Those, I think, are the major changes going on.
And I would just like to note that we do have concurrence memos for all 3 policies from PCA.
PCA? Neil, anything? Okay.
I had a question on page INV 526 under 5A. It has a asterisk that says this report is not presented to the board. Is that something that you find in your other policies that specifies that a report's not presented to the board?
Yes. Yes, that's correct. The monthly reports are generally to the DCIO, the CIO and the DCIO, and those do not go to the board. We just wanted to state out of all the reports that we do for each program, what goes to whom.
His question, though, is that in other policies?
It is. Should be.
And I think part of it, Brian, was in response to questions we've had from internal audits in the past to get, so they know clarification of what goes
So they know
to
the
where.
distribution.
They've asked us also that Michelle and I, the CIO and DCIO respond back to confirm receipts. So they want to see a clear paper trail in their flow diagram.
Okay. And I assume it's still up to the board whether or not they would want to receive those reports. Okay.
Dana?
Thank you.
So Brian, is there a better way to put that? Instead of just that the report's not presented to the board, so maybe we can say something, it's prepared by the operations and fixed income staff and presented to the CIO and DCIO monthly. And then we don't have something in our policy that actually reads, this isn't presented to the board?
Yeah, I would think a staff level
Yeah.
report,
I-
or something like that for
Yeah.
us.
Thank you.
Absolutely.
We could take a look at all our policies then and check that
Not
out.
see that kind of language in there.
thank you.
Any other questions from board members? Great, thanks so much. All right. Paul, Glenn, thank you, and Neil. We're done. All right, oh my gosh, I can't believe this. Item 21, review for information requests. Do we have any, Jill?
Oh, I think she has a
I
list.
believe there was the one where you requested the CIO and then our consultants, PCA and Makita, to provide a ranking of the discussion topics at the next meeting. That was the only one I had.
Great. Thanks, Jill. Number 22 is our draft agenda, so you can take a look at that for the next meeting. I'm assuming that agenda will be tweaked relatively, since our conversations yesterday and today. What's that?
We'll prune it.
We will modify, edit, add. And then any opportunities, any members from the public?
Sharon, I know I'm not a member of the public, but just in the interest of the board's time and the length of the board book, you just went through those 3 policies, they're information items. You could convert those to action items and approve the revisions if you didn't want to see a second
Oh,
reading.
otherwise they come back as a second
Otherwise, they
reading
come
and
back to you, and that adds to the,
I think we should-
so I'm not suggesting to rush you, but it just
No.
from the
I
dearth
appreciate it.
of questions, I thought maybe it might be something you want to take action on.
Okay, Dana?
Yeah, with the
Can-
amendments.
Can we approve them with possible grammatical corrections after we do that? Okay, because I have to check something before I ask Chris.
Well, I don't mean to rush you, I
Policies.
just was trying to make it.
No, we're very much
Anything to make
hyper
us
aware of that also.
More
So,
efficient.
I would move all 3 there were 3, weren't there?
18,
Yes.
19,
All,
and 20.
all 3 policies, 18, 19, and 20.
Subject to grammatical revision.
Yeah, with grammatical revisions.
So it's been moved? A second? All right, any
Yeah,
discussion, Paul?
I just want to clarify. So are we going to move that matrix into the policies or just, okay, so that's part of it. Okay, wonderful,
bet.
thank you.
And
for
grammatical corrections
clarification.
from Dana.
Okay.
Okay.
With the corrections that will be then.
So it's been moved and seconded. All those in favor say aye.
Aye.
Opposed? Abstentions? Great. Thank you, Brian. Thank you for helping us be more efficient as a board. We always appreciate that. And with that, I will adjourn the investment committee, everyone, before 2 p.m. on a Friday.
Woohoo!
So there we go.